So, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. I'm Merrill Chandler, and welcome to the Are You Effable podcast. Welcome, everybody, to the Are You Effable podcast. My name is Merrill Chandler. I'm your host, and when we come back, we're going to tell you, remind you, and even tease you a little bit about how to make sure you protect your fundability when you go out shopping for this holiday season. So when we get back, hold on, because I hope I don't pull the rug out from underneath you. See you in a second. Welcome back, everybody. Okay. We're talking about the holiday season. We're going in. Now, this can happen all year round, but people are especially susceptible to questionable borrower behaviors, right, during the holidays. Because sometimes we spend a little bit more than we normally would other times of the year because our gift giving, the things that we want to do to take care of our families, our loved ones. So I'm gonna go through a few some landmines to watch out for, and ways to do it well, ways that you may have done it in the past where you've literally blown up your fundability, and over time you've decreased the value of your borrower profile. All right. So first things first. This one, as you can tell, the podcast was labeled "How to Save 10% on Your Next Purchase and Ruin Your Credit," or in other words, how to ruin your credit and save 10% on your next purchase. What do I mean by that? All right. Invariably, all year round, but especially during the holidays, lenders who are backstopping or carrying the paper for merchants all around the country, they want to get new cardholders. And what I mean by lenders who are carrying the paper, let's say you go to Target, JCPenney, pick any mall store card, guys, any card that's offered on the internet. Any of these cards, you will, using JCPenney, or let's use Target. When you get to the register, they say, hey, I'll give you 10, sometimes 15, every once in a while, 20%. I'll give you 20% off this purchase if you just fill out this application. Well, you're sitting there going, I can fill out an application, but the thing is you don't not necessarily understand what they're asking or how it's going to harm your profile. Now, in previous episodes, we kind of covered a little bit about this, but I want to bring it up again during the holiday season. First and foremost, when you fill out that application, it's a store card. It's a mall store card. It's what's called a consumer finance account. FICO already counts it against you. If you have a consumer finance account on your credit profile, you get a downgrade in your fundability. But because you're spending a couple of $100, $200-300, however much at Target, you're thinking, yeah, I'm going to save $20. But what you don't understand is that $20 actually puts it's like stabbing one of your tires, and you're going to be driving around limping because all of the fundability air has come out of this tire, right? Can you get around with your credit profile? Yes, but it is hard, it's annoying, and you will not be able to get up to speed. You really do blow up your fundability chances. Now, unless you're spending $60,000 at Target, guys, then talk to me. I'll help you navigate these waters, because saving $6,000 is a big deal. But I haven't met anybody yet who's going to go spend $20,000, $30,000, $50,000 where this kind of savings is important. Most of us are always running up against a bill of, what's in our cart's worth, I don't know, $100, $200, $300. It is not worth the $10, $20, $30 savings in order to that you get by filling out the application. Now, it's a mall store card. It is a retail merchant card. Now, part of the reason why these merchant cards are less valuable is that it's merchandise. So let's say you buy you buy a sweatshirt for one of your children. That sweatshirt costs, let's say, 20 bucks, 30 bucks in the store. Well, it costs $2 to $3 for the merchant to purchase it. Okay. So when you have $1,000 Target, let's call it Buckle, let's call it Express, Victoria's Secret. If you have a $1,000 credit limit on that retail card, they only have probably $100, maybe $200 at risk of the $1,000 of value, those are air quotes, of value that they're giving you. So it's not real money. Their only loss is 10 to 20% of that credit card limit. So that's one of the reasons why these cards are less valuable. It's compared to a Wells Fargo cash card where you have $1,000 credit limit to use like cash anywhere that takes the MasterCard, Visa, whatever. That's treated like cash. And that cash is dollar for dollar. $1,000 for Wells Fargo, a limit is $1,000 at risk. So there's more value to that card. And the more value there is to the card, the more risk there is to the card issuer. So this is vital that you going in and filling out this application, it's not going to do for you anything for your credit profile. It actually destroys significantly. You blow up your fundability by filling out that card. Now, if you do 1 or 2 or 3 of those cards because you're going shopping for Christmas, for the holidays, for Thanksgiving, on Black Friday, holy hell, they're going to offer you terms, or the merchants may offer you, ask for a credit and we will get you and we'll give you a discount. It's because all of these stores, including the Black Friday offers, when they get you a revolving account, then you're more prone, more likely to use it. And that pays them interest when you carry a balance, right? Every time you run that card, the merchant is collecting, or the processing company is collecting 2, 3, 5% of that purchase. When you run that card at Kohl's for $100, $3 to $5 goes into a split between Kohl's and the issuing bank. So everybody wins on the lender side when you have an extra one of those cards. And that's why they give you rebates. That's why they give you points so that you can have free merchandise, etc. And while all that is fine and good, it is ruining your fundability. Those very credit instruments, those very retail cards, merchant cards, are a death knell, especially when you have too many of them. The other thing that's important is it makes you look like a consumer, not a professional borrower, right? You're just picking up credit helter-skelter. And that is not a good message to send a lender, especially if you're looking to be a professional borrower. You're a business owner, entrepreneur, a real estate investor, and you're looking to create a credible professional borrower profile so that lenders take you seriously and give you the higher echelons of credit, right? $20, $30, $50,000 business lines of credit and more. You got to be a professional borrower to take those down. So having these retail cards on your profile does not do that. Actually, it hampers and hampers and hogties your fundability. Now, the next thing where there's a negative impact is that when they pull that credit, whether or not you're approved, you get a 3 to 15 point deduction in your credit score. And your credit score, while it is the 3rd or 4th most important when it comes to fundability, the 3rd or 4th most important metric, it is still in charge of rates and terms, and even where applicable, how high the limit is going to go. So we need our score to be high if we're going to increase our limit amounts, our loan amounts, and get the best rates and terms. So that inquiry is going to drop your score, even if you don't get approved. Now, The other thing is that I mentioned in our previous episode a couple of weeks ago is that if you are approved, then you get a new card with 0 months on it. This the 0-month card reduces your average age. And that average age is, we call it a revolving accounts portfolio. It's the collection of all your credit cards, charge cards, home equity line of credit. It doesn't have to do with your car loan, your mortgage, your installment loans. This is only the collection of your revolving accounts, right? Those credit cards, etc. Your age is a very, very important feature of your profile. And when you get a brand new card, you get a new card with 0 months. So let's say you have, just to make it really, really simple, let's say you have one credit card at 100 months. Your average age, because there's only one, your average age is 100 months. But if you go get a brand new Target or Kohl's or Victoria's Secrets or Home Depot or Staples, you go get a new card on your personal profile that's one of these low value cards, your average age is going to become 50 months because 100 plus 0 is 100 divided by 2 cards now. You just dropped your fundability or the age in half and just took a massive hit to your fundability. So guys, in this holiday season, happy Kwanzaa, happy holidays, happy Christmas, or Merry Christmas, happy Hanukkah, right? Merry, happy, fruitful Thanksgiving. Even for even you Seinfeld fans, Festivus for the rest of us, right? Whatever holiday you're celebrating, whatever holiday you're going out and shopping for, I beg you, unless your pocketbook has to realize the savings, do not acquire any new junk card. If you need a little bit more shopping power, buying power for the holiday season, I don't encourage consumer debt. But if you have to do it, if you're forced to do it, then make sure that you get a tier 1 or a tier 2 credit card that's a cash card. And there are plenty of those that have benefits, miles, rebates, etc. Plenty of those. Go to find out, read my other blogs at getfundable.com, or keep binging the podcast, because I mentioned in various podcasts different credit instruments that are perfect for your profile. But please, wherever possible, my holiday gift to you is the knowledge, the awareness to stop stepping on the landmines, to stop blowing up your fundability, to stop doing the things that continue to and regularly destroy your fundability. This is Merrill Chandler wishing you an amazing holiday season, and please protect the most precious and valuable financial asset you have, and that's your borrower profile, your credit reputation. And let's protect that and punch through this season. Let's hit the new year with ready to go, right? Ready to go. If you haven't done so, go to my website, getfundable.com, check out the podcast, buy my book, make sure you got all the tools you need to make the best decisions this holiday season you can possibly do. I love you guys. Happy holidays. Have an amazing day.
Hey guys, thank you for listening to Are You Effable? Please leave comments because I would love to read about your aha moments from this episode. And be sure to visit fundinghackers.com to view the blog post, get important links, join our community, and much, much more. And you gotta tell your friends about this podcast. We want them to become effable too.